All right, everybody, we've got our main event here.
I want to thank you all for being here. So thank you. And the best is yet to come with John and Chris.
Thank you. Well, I am supposedly moderating this panel, but with two individuals who really need no introduction, two leading lights of value investing, John Rogers, who founded his firm in 1983, Ariel Management, and Mario Gabelli, who's mid-career compared to Warren, but who founded his firm, Gamco, in 1977. I've had the pleasure, usually, of working with Mario for the last 22 years and have learned a tremendous amount, and we're going to talk a little bit about their businesses, talk a little bit about stocks, but we're also going to talk about Buffett. So with that said, maybe we'll just start with, among the many things that Warren has added to the value investing canon is the notion of an owner's mindset, buying business as opposed to abstract security. So in a world of zero-day options and triple levered ETFs, how can investors use that long-term mindset to enhance returns? We'll start with John.
Well, thank you. It's great to be back. It's really a privilege and an honor to be here and to be here with you, Mario. So thank you.
Well, I'm thanking you, John, for being here, not the other way around. Everybody for John, thank him. Yes. Now, how do you look at a company, intrinsic value, and how does Warren do it, and what do you think is changing?
Well, I think to the question, I think that people are, we all know, more short-term oriented than ever. I was talking to an investment banker, a brokerage firm last evening here, and he was saying how all their money managers only want to come in and talk about what's happening next quarter. Did you beat or not beat? People talk more and more about how companies are screened and looking at companies without really getting behind the underlying economics of the business. How does the business generate cash flow? What's the significance and size of the moat around the company that allows you to own the company for the long run? Getting a sense, do you have a management team that's owner-oriented and cares about all shareholders, just not about themselves and their own personal wealth? So those are the things that we look at, and of course do the discounted cash flow analysis to try to determine what the intrinsic value of each company is and buy them at least a 40% discount. But with this long-term perspective, a company, we want to own companies for 10, 15, 20 years. We've been doing that. And our tortoise logo is now almost 43 years old. So we still believe that slow and steady wins the race.
We don't do anything differently. What we do is bottoms-up research, fundamental analysis, and we look at a company and we try to visit the company, the competitors. We did it primarily U.S., and then when the Berlin Wall came down in 1989, we went global. You visited the companies around the world, but we didn't invest in them. Now, for the last 30 years, we do that. We just opened an office in Zurich because a couple of the individuals there cover the utilities industry. We had someone in, we have a team in Shanghai, Tokyo, and we lost an analyst. No comment. Somewhere in that part of the world. Independent of all of that, what does Warren Buffett do? How does he think about holding businesses for an extended period of time? But go back to his question. I started day trading way back in the night, and basically, if you were at home in 2000 and they gave you money, what was the thing they gave you to stay home? Gimmies, shimmies, or whatever they called it?
Yeah.
You would buy and sell. So when I listened to CNBC, whatever the TV station is, they said, what is an investor doing trading today on this news? I said, that's not an investor, that's a day trader. So there is no question that some of my friends are extraordinarily capable of doing day trading. And nothing wrong with it. What we do is look long term. We think about how do we create wealth and maintain wealth, and how do you do it by buying companies like John just shared with you. What is the intrinsic value? How do they generate cash flow? How do they allocate it? You just heard a part of that from Valmont, okay? Valmont announced a little and the stock drops from 320 to 275 in one day. Trading, volatility, yeah. Today it's 310. Where is it going to be in 10 years? Now, just think about this. I started in business, the Dow was 1,000. 17 years later, it was 1,000. Today, it's 40,000. It's going to be 1 million in 40 years. Anybody want to be with me here? All the short-termers, that's only about an 8% CAGR. For the last 100 years, the markets have gone up about 10.3%. So that's where we are.
Part and parcel of compounding wealth are taxes, and it's not what you make, it's what you keep. Warren is probably less appreciated for how extraordinarily tax sensitive he is. Again, how do you apply that in what you do?
Well, it's not complicated. There's no question the government is getting screwed by ETFs. I love Larry Fink, but what he does every day is if he has a stock that goes up, he gets it washed out. The ETFs, and all of you that are RIAs, you have to own ETFs for clients that are taxable. We have to migrate in that area, or we will be a shrinking ice cube. Either that or the system has to change. Okay? We have stocks in XYZ portfolio that the tax basis is $200 million and it's $1 billion. If I sell it, I'm going to have to, that taxable client has to pay, assuming he's in a great state of Wyoming. I know there's no taxes in Wyoming, if you know that, at the local level, or about 7 other states. He's going to pay 23.8%. So we would like to create a synthetic ETF. What does that mean for those? If you're in this room and you buy an ETF, if you're doing it for tax-free clients, that's terrific. We have to migrate into that area.
I was going to say a couple of things. We manage an ETF with Charles Schwab, and we're thrilled to have that partnership. But I do think, as you talk about systemic change, is something I think is important to be fair to mutual funds, because now it's an unfair playing field between mutual funds and ETFs. The Investment Company Act, the Mutual Fund Act is it's the Investment Company Act of 1940. It's 85 years old. It hasn't been adjusted. It hasn't really changed in any significant way. And I think our trade organization, the ICI, has a responsibility, I think, to give mutual funds a fair shot to compete with ETFs. And I think we should be lobbying for that kind of change and making sure that people understand that mutual funds still are a great vehicle for a wide range of American investors, and we should help them be able to do that tax efficiently.
Yeah, I agree with that, but I'll give you another aspect, though. If I'm buying ETFs, think about all the companies that are ignored and unloved. Ignored and unloved. There's a company in XYZ, Pennsylvania. I'm not going to give you the town because there are only 3 or 4 companies located there. And basically, that stock sells at $15 a share with a $1.16 dividend, earning $3, and the book value is $30. Why? It's not in an ETF. Nobody covers anyone. There's no sell-side analysts that do research and then publish it for commission dollars. I've disappeared because they have to follow bigger companies or they're out of business. So the structural change on Wall Street has happened. Secondly, I don't want to take my company public. So the number of public companies are slowing down. Why don't I want to take it public? There's too much regulation, too much BS, and we have to change that structure. But that's a different story.
Well, actually, it's a great segue to my next question, which is on small caps. Obviously, the size of Berkshire's balance sheet has necessitated elephant hunting, but in the partnership days, Warren made a lot of money at small caps. You both have mined that area very successfully.
Yeah, this company has 6 million shares, so I'll give you another hint, and it sells at $100 million market cap. Reasonably, the products are fantastic, and the stock will double or triple, but nobody's going to be able to buy it because you don't own it in an ETF.
So is that structural? Or is there, small cap as a category has obviously lagged the larger cap companies for the last decade. Is that going to turn around? Does that change? Does that change how you invest?
Well, we're actually getting our Ariel fund, our flagship fund, is still a small cap value fund. Started in 1986 as a small value fund. We still believe that's where you can find inefficiently priced companies. We've been fishing in the same fishing pond this entire time and believe that's where opportunity is. But we believe it's more than ever, because right now, as we've all heard about and studied the Magnificent Seven, how great large cap growth stocks have performed. We all know that. It's been a hard place to be. But right now, the data is crystal clear on a historic basis. Small value is at one of the biggest gaps between large cap growth when it comes to valuation in history. These are just being sort of bargain-priced companies that people have fallen out of love with. And of course, what happens is the analyst community follows what's been going on Wall Street. They want to spend time on the large cap growth stocks because that's where all their customers are. So the quality of the research in the small value sector is the worst I've seen. You know, the lack of depth. You know, you talk to analysts who say, well, no one's called us on these companies. I'm not really up to speed on it any longer. And so the research is really a mile wide, but an inch deep. So it creates opportunities for those of us who are going to go out and do the work in the small value sector to find some true bargains that are being neglected, being left for dead, where there's real opportunity.
Yeah, we would like to share with you some of these companies, but don't think just in the United States. For example, I'll give you a company. We just opened an office in Zurich with several individuals that work for Credit Suisse. And basically, we have an office in London for the last umpteen years. But there's a company called Iveco, I-V-E-C-O. They have approximately 270 million shares. 30% of that is owned by the Agnelli family through an entity called whatever it's called. That company has a defense business. All of a sudden, every European is calling us to find out, because our specialist in defense and security, likes that business. Iveco has a business that could be sold, and the company is selling at 1 times residual earnings. You take Japan, you take a company like Kikkoman, you take China, Tencent Music Entertainment. These bargains are there because they're not, and they have reasons that they don't exist in portfolios. So that's what we have to do. How do we create wealth for you? John is doing it for you. Ariel is fantastic. And basically why? Because he's like Buffett. They are marathon runners. And they think long term. They're not short term sprinters. I have no problem. If I'm XYZ and I'm a sprinter, that's okay, as long as they're consistently sprinting, as long as you're tax free. And if you don't pay taxes, let me know, because I get a piece for being a finder with the government. Oh, come on, laugh. Oh, come on, you go dull and boring.
So you both are also industry specialists. We call it compounded accumulated knowledge of certain industries within our firm. But even Warren has ventured out into other areas, as we talked about on the first panel, with Apple being still the largest equity holding in the portfolio. How do you find new areas that are interesting?
I think one of the ways we do that is to make sure we're hiring young analysts who come in with fresh perspectives. We do a lot of, I'm from Chicago, live in Chicago. I went to the University of Chicago High School. A lot of people don't know there's a K through 12 school there that's owned by the university. So we hire a lot of people from what's called the University of Chicago Lab School, a lot of people from the college, a lot of people from Booth Business School who can bring in all the fresh perspectives and points of view. So have a little bit of bias, a hometown bias. I know Mario loves another institution in New York that does extraordinary, like Columbia. But we really believe in finding talent that can really bring in those fresh perspectives, understanding how AI is changing various industries, what's happening as the media landscape changes, all the different parts of the world that are being disrupted. To your point, you have to evolve with the markets, because the moats don't always stay permanent, and you can't assume that they stay permanent. That's always going to be a mistake if you cling to those old habits and are not willing to adjust to the new world.
A great question. Think about comic books, Dick Tracy, wireless phones. Duh. Think about 1977, May 1977, something happened. A movie came out called Star Wars. They had R2-D2 and 3CPO. Artificial intelligence, it was there. So what's so new about it? We're just learning how to invest in it, but if they do invest in it, and AI is important, and you all can do it for free by going on ChatGPT, and so don't pay the money if they're asking you to pay for a monthly subscription. Don't worry about it. I'm not paying it for you.
I know.
I know. Bottom line, well, you got to be practical. Bottom line, Think about how AI will influence the world on gathering data, of creating information. You won't need John and I except for judgment.
So a lot of Berkshire letters, including the last one, have emphasized the importance of finding excellent management. How do you identify excellent management, and how do you weigh that as a factor versus price and quality assets?
I guess for us, we think the price and the quality of the assets, the number one thing we're focusing in on is, I've said it several times already, but is the strength of the moat. You know, how likely is this industry going to be disrupted going forward? There's nothing more important than that. And as Mario said, I know how hard he works at it, talking to competitors, talking to customers, talking to people, former employees, understanding how that moat is evolving. There's nothing more important than that. Of course, management is important, but it's hard to get to know whether, people are good talkers. And we talk to every management team every quarter and talk to them for years. So one thing is to be able to build consistent relationships with the management teams to determine whether they're executing their strategy consistently. Do they have a plan to win? Are they staying on that plan to win? And if you see that discipline, that's something we look for in management teams. We use this company, BIA Associates, that I don't know if you guys use them, but they help us ask better questions and help us determine the veracity of the answers when we're interviewing a management team. The BIA is filled with sort of former government officials, CIA, FBI, people who know how to ask the best questions and determine whether people are telling you the truth or not. And I can't say how important that is as we build our relationships with our management teams. And then finally, we're trying to get outside help more and more to help us do the background checks on management, how they've done their last 2 or 3 jobs. So not only, of course, we're going to ask the management a lot about their histories, but then getting independent verifications of their success, where they've worked before and what they've accomplished in their prior jobs, and what's led them to their success. Who've been their role models? Who've been their mentors? What values are they ensconced in? That's so critical when you're looking at a management team.
If you entrust your assets to someone, first of all, you think about most of the individuals in here are self-reliant, understand how to do analysis, how to do investing. But when you watch these TV shows, they're just fanning the dynamics of today. Think about the next 5 years, the next 10 years. Start off by asking yourself, how much money do I want to create? Where am I going to leave it? How much cash am I going to get in? How much cash am I going to have to spend? And what do I need to buy something opportunistically, whether I'm running a business, running a country? And that's the way you have to think about how this guy, never mind. I was going to talk about the President of the United States.
I will get there, don't worry.
No, I will not get there.
The,
if you got tariffs, you're spending $4 trillion to bring stuff in, and you're only selling $3 trillion. You're out of pocket $1 trillion. What are you going to do?
Let's talk about excellent management at Berkshire first.
Well, that's
So,
not
Greg,
necessarily inconsistent.
That's true. So Greg Abel,
You notice how we are being practical here.
Berkshire Hathaway. What advice would you have for them as we adjust to a world with less Warren? You think Greg is going to be able to change the trajectory of what's going on?
Another short-term question.
Well, I mean, the quick answer is it's like, following Michael Jordan. I'm from Chicago. We haven't won a championship since he left. It's really, really, really hard to follow Warren. He's the greatest investor of all time. There's no question about it. People can argue, in all other fields, who's the best of the best, but Warren is the best of the best. So I think what Greg can do is to live the playbook that Warren has put in place. And I know he believes in that playbook. And so not going in there and trying to change and adjust and do something different, I would have Greg, which I'm sure he will do, because he believes in Warren's values and Warren's been a mentor to him. So I think that's the best way. Keep a belief in that playbook. It'll serve him well over the next 20 to 30 years.
I would add, Warren in his annual report this year went to confession. He did it other times as well. He said, I paid a dividend of 10 cents a share about 20 years ago, and it still bothers me. Is Greg able to withstand the pressures of people on Wall Street in terms of capital allocation? Does he have that kind of mentality? Is Ajit Jain creating what he's done for the insurance business and The successor who came from Allegheny that's been identified, is he in turn doing that? If you believe it is, remember, today is May 2nd?
It is.
90 days ago, or 120 days ago, at the beginning of the year, the people on television that you listen to saying, Buffett doesn't get it anymore. He has no idea what's going on in the world. Now the same guys are praising him for having sold some Apple. You don't make this up, just watch. If you want to read a story, I'm not going to do this, read one newspaper here, one newspaper there, and you see the same story with different endings. Warren has never changed except for that. He also sold some stock recently, so that hasn't done before. He's always bought it back, but hasn't done it recently. So Greg is learning how to do that. He's showing a lot of the side and the styles. Now, at a previous meeting, somebody said, well, maybe we should do something with Canada. Greg came out of Canada. He's also been involved in the utility business. He understands inflation and so on. We'll see. Now, Warren has at least 15 more years. He'll only be 110. He's got to take some of the money back from the Social Security he's been paying.
So,
if he takes it, no, seriously, do the math. If he does $100,000 a year in wages and a little bonus this year, and he pays 7.2% for his Medicare and his Social Security, and he's taking out $48,000 for Social Security, he's getting a benefit. He knows how to count.
well, Warren does still have to work for that money, and we're going to put him to work tomorrow, I'm sure, in the Q&A. And one of the questions he undoubtedly will field is his view of the management of America, Inc. We don't have to get ad hominem, but any advice you might have for how we tackle our twin deficits that pre-existed current
Yeah, to give you
management?
the math, right now, the United States spent $7 trillion for the fiscal year ended in October of blah, 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 last year. We took in 5. Deficit, $2 trillion. The United States exported $4 trillion, imported $4 trillion, we exported $3. That's $1 trillion. Twin deficits. More importantly than that, we as a country have $10 trillion coming due in the next time period, and we have to roll it over, and the cost of that capital, with the T-bill at 425, the average cost on that capital was 350. So that's 75 basis points on $10 trillion. That is what they say in Italian, bupkis. They say it's not bupkis. That is, it's a lot of money. I wish I could do it in another language, like Russian.
Got nothing to add.
Nothing to add. Yeah, that's a good response.
We got to have Putin understand economics 101.
So maybe we could talk a little bit about stocks, something I know you both love to do on the Barron's panel, amongst other things.
Relax.
Sports.
No, seriously. What do you think? We don't want to get into politics too much because that's not necessary. But what are the priorities that one has to do, and how would we implement it? That's I think that's what everybody's asking, and we're not going to answer it.
Well, I think I have the two big concerns. I mean, I mentioned the University of Chicago. We mentioned the great universities in New York. There's great universities. I think the attack on our university system is something that is, I think we have to sort of make sure that we win that battle, because I think that's helped make America great, the research that's done, the way that we educate our communities, the jobs and vitality they bring to local communities. I think that's really, really important. And then I think we need to end this tariff war. I think that is something that just long range doesn't make sense at all. And I'm hopeful that the Supreme Court will side the right way and say that he's overreached with the IEEPA legislation, and it really wasn't set up to be able to allow this kind of mass tariff increases throughout the world. And I think that gives me some optimism, because I think when that court case comes down, it'll ultimately free Donald Trump to be able to be maybe get away from this perspective of fighting for tariffs as hard as he has.
Thank you. I can see the Chicago point of view. Basically, from my point of view, he grew up in Queens, New York. He was a real estate guy. Have you ever met real estate guys that don't like to haggle? They love deals. They love to negotiate. The only problem is that also, if he thinks you're saying something that he doesn't like, he's going to attack you first. So get used to it. Claudia Scheinbein She has done a fantastic job of dealing with them. Try to analyze how she's done it, as opposed to the guy Trudeau in Canada. They got to know how to deal with those kind of issues.
So,
In
John,
any event, Claudia is the CEO of, not CEO, what she does? She runs Mexico. She's done a great job. She understands how to deal with individuals.
so next topic. You, John, you went to one of those aforementioned great universities. In fact, you were captain of the basketball team at Princeton. Many people don't know how tough Mario is in the kitchen on a pickleball game, but both of you focus on sports. Why is that? What's the bull case for sports going forward? I'll start with you, John.
I think that, well, we all know the case. Everyone knows the case here. It's one of the things that people still want to watch live. So it's so valuable to advertisers to be able to reach consumers through the advertising and so sports media rights continue to go up and up and up and explode. And I think that's something that will continue to make these franchises worth more and more money over time. I also think they'll go more and more global. As Mario's talked about the importance of going global. You'll have teams that someday the NFL and the NBA will be playing all over the world. You'll have people on their phones being able to watch these sports all over the world. You think about all the rights that will come when you can have all those eyeballs throughout the world watching sports content and these valuable brands and franchises that have been built up, whether it's again the Knicks or the Rangers or whether it's the Yankees, et cetera, et cetera. So I'm really bullish long term on the sports rights.
Think about television, think about ratings, think about Formula One. There's various types of entertainment that can take place. In the United States, there's something called the National Football League, NFL. They're allowing 10% of the ownership to be transferred to GPs and LPs. Chris knows these numbers better than I do. Basketball, hockey, baseball are allowed 30%. Be careful. The GPs that are coming along are going to sell you LP units. And they don't tell you about liquidity. They don't tell you about the other stuff. So right now, I want you all to buy, without a GP, an ownership interest. John bowed his head when he said the Knicks, But you can buy one share of a baseball team for $40. It's called the Atlanta Braves. Give it as a present to your wives for Mother's Day, and their wives can give it as a present to their husbands and their grandchildren. The second thing is soccer. Just think about what's going on Man U, and think about what Abu Dhabi did with regards to Man City, and think about that dynamic. Next year, you'll have a World Cup. The World Cup is in Mexico City, and what's that place in New Jersey? I can't stand New Jersey.
It's East Rutherford, New Jersey.
What is it?
East Rutherford, New
Yeah,
Jersey.
he grew up in New Jersey. Bottom line, it's called MetLife or something. And what companies do we want to own? The company in Mexico City is selling at $1.20 a share. And they spun it off from Televisa because the family wants to control it. What else can we buy? Do we buy the ones in Germany? Do we want the ones in Italy? How about the ones in England? And how do we play that on a global basis? So those are the things that you have to like about sports. And you want to own a piece of a sports team, but not the guys that are doing the GP LPs. They're probably in the room here. Stuff such as life. You're dealing with all types of people like me that tell you that you shouldn't sell it.
I have a feeling there might be a few questions in the room here. We do have mics. Please raise your hand, and we will try to get them to you.
And we'll do it fast.
We'll do it fast.
Yeah,
Lightning
quick.
round.
There's one on both sides of that table.
bad.
You guys are the East and West?
Hey, I'm loud. Spencer, 24 years old from Seattle. My question is, do you see any U.S. Treasuries repayment risk, or is that a line that can never be crossed? And if so, how do you handle that?
That was a question about treasuries and repayment risk. With the fact that question is even being asked says something. But do you want to take a shot, John?
I would just take a shot to say that I think that's not a risk. I think, again, our country is the strongest economy in the world. And if you think about it, I've talked to some friends who've worked in high-level government jobs in Treasury and other White House jobs, who often talk about the assets that we have in this country are not on the balance sheet. things you kind of think about and we take for granted, for the Grand Canyon or the White House or our extraordinary park system, all the different assets that are that are there. One, you could, maybe you would never sell the Grand Canyon, but you could name, it could be the Gabelli Canyon. And
He's not paying for that.
The basic dynamic that allows me to believe that the $36 trillion that we owe, or the $38 trillion, and the amount that's owed to Japan and China are elements. The free market system with all the flaws, the rule of law with all the flaws, and the underpinning of all of this of meritocracy. So everyone else, you're sitting on a chair. Under the chair is a school that wants your contributions because we want to maintain meritocracy. So I'm asking you to contribute. No, I'm not. That's okay. You can do it voluntarily. Otherwise, you can't get up.
We also
from my point of view, as long as the system allows people to get elected every so often, we're in great shape.
We also have the exorbitant privilege of being able to print our own money. Seniorage and inflating the debt away is another issue, but...
And, there's no reason not to own a piece of gold.
Thank you. Adi Orzel from Israel. Question about Berkshire valuation. Do you guys see in the coming year as maybe this tariff trade de-escalate or continues? How do you see it in terms of the valuation of Berkshire that risen up in the past couple of months? And then maybe a second part for Mario. We spoke in the past about Paramount. Do you see it as a merger arbitrage opportunity at this time? Thank you.
So it's a question about the valuation of Berkshire currently and Paramount.
Which one do you want to do? You want to do Berkshire?
I would just say quickly, I think Berkshire is still undervalued. I think it does not reflect all the assets that are there, all the wonderful businesses that are owned. And I want to own it for the rest of my career in my personal account, and I'm hoping my daughter will keep it in her personal account forever. So I'm not worried too much about the short-term upside. I know he's gotten off to a great year this year, but we're there for the long run.
Yeah, you have to echo that comment. Even though the stock has got a $500,000 book value from an accounting point of view, and the stock is selling at a 60% premium, Buffett is a cushion for you because he knows when to buy it back if he adds intrinsic value on the value of what remains. From a point of view of Paramount, you own the stock?
Yeah.
Which? You own the voting or non-voting?
Non-voting.
That's too bad. The stocks were at the same price a period ago, and so we elected to have the voting stock when it's at the same price. Right now, there's 40 million shares of voting stock. 30 million is held by an entity called National Amusement, which Sema Redstone had when he passed on to his daughter. And Sherry has 30 million shares. She decided to liquefy it for a lot of reasons. And there are 10 million in public hands. The symbol is PARAAR. We have clients that own 5 million of that. 5 million times 23 is $110 million. Even if it was 25,000, we would work hard to fight for it. And so we're suing. What do you suggest? That I get half the price that she paid? That she got, I mean. Yeah, I know. That's why we're suing.
Hi, my name is Sid Churari.
At our expense so far.
I am Sid Churari from India. My question is about identifying fanatical founders early before the market. The concept of power law where a few companies power the index, whether it's Amazon, Microsoft, Walmart, Costco, but many of these outliers had fanatical founders. So what traits do you look for to identify these fanatical founders?
Fanatical founders.
Fanatical or obsessive?
What was the question?
How do you identify fanatical founders who are going to power great companies?
I guess I'll just say that I think it's important that not only do you read thoroughly everything, from the Wall Street Journal to the New York Times to Forbes and Fortune and Business Week and Barron's, and you go on and on. We especially love Barron's. But you've got to read about who's coming along, what's the next generation leader going to be. And then I think coming to conferences like this, or Berkshire Weekends, where you get a chance to network with really thoughtful investors and stay in touch with those thoughtful investors who give you their best ideas. I meet so many people here. I always try to always show up, because when you meet these smart, thoughtful people, they tell you who they know and help identify up-and-coming talented people. And as I said earlier, finally getting engaged in the alma mater, and I've said several times tonight, the institutions where the young, dynamic leaders are coming from, getting to build relationships with professors, being involved with your alumni associations. That's where I often find a lot of talented people. I met Melody Hobson, many of you know, who's the co-CEO of Ariel Investments. She's on the cover of Fortune magazine recently as one of the 100 most influential investment professionals and business leaders. I met her as a 17-year-old prospective Princeton student. I was volunteering to help Princeton and met my most valuable player. So I just tell people, get out of their seats, get out and visit, meet people, volunteer, help others, and then you get to have a chance to see all the talent that's out there and open up your purview to see those up-and-coming leaders and see who has that special energy, who has that special vision. It's hard to find, but it's not going to happen just by sitting at home.
Yeah, we'd do the same thing. We have a guy, an individual next week coming in. I've known him for a period of time. He runs Sony. Sony has 5.2 billion shares. The stock's 25. And Yoshida is passing the baton on to the next leadership. And so you watch, how do they build a moat? What are they doing in selling to Spotify? What are they doing with regards to the entertainment business? What are they doing with regards to the games and how are those businesses being handled? How do they allocate cash? So they've had a good, in Japan, Kikkoman, another good example of that. In China, my first visit, I went to see Sir Run Shaw and asked him the same questions. Basically, it requires a lot of work. And some companies like John Deere, you can look at 150 years and you can see every time they picked a CEO, it's worked. And so it's not easy. So as Charlie Munger would say, I have nothing else to add.
Well, we don't even have peanut brittle or Coke to keep you guys going, but maybe we'll have time for one more question. You got it? Otherwise,
If not, we're here again tonight, but John is running a great money management firm. You should consider giving him some assets, ARIEL, and he's in Chicago, and I've given him some of my own money to manage. So thank you for being here.
Thank you. Can I say one?
Please, and you got more questions?
One area that we also share, and again, as I said earlier, no one works harder than Mario, but this idea of experiences in our society. Sports is a part of it, but we think people now want to experience things with their families. So a lot of the names you'll see in our portfolios are benefiting from experiences. So companies like Norwegian Cruise Lines, people are cruising more with their families. One Spa that does the spas on the cruise ships. I was talking about it this morning on CNBC. You can get a spa treatment, you can get a massage, you can also get a facelift on a lot of the ships. It's pretty amazing. People put high margin on that kind of thing. And of course, we continue to love the Sphere in Las Vegas. They just signed up Wizard of Oz is going to be the next movie starting in August, and you'll be able to feel like when you're in the Sphere that you're actually in the cyclone with Dorothy. It's going to, Google has used AI to make it going to be a magical experience that we think is going to blow Vegas away, and it's going to be a worldwide phenomenon. And of course, Madison Square Garden Entertainment.
Can you give me a discount for Sphere, John? Nothing.
Well, Sphere's gotten very, very cheap, so we think it's about a 50% discount at least. Some of the analysts have come out and said it's worth $60 and it's in the mid-20s. So we're really quite optimistic there.
as am I.
By the way, I should mention that Chris Morangi is our Chief Investment Officer at Gabelli Asset Management, and Max Sykes, who's here, is also a portfolio manager. So you've seen some of my teammates on the back of your envelope, a dirty dozen, but we have a lot more that are equally focused every day with passion and intensity. So we like to hire PhDs, passionate, hungry, and driven, much the way John did. Not Princeton hungry and driven, but passionate, hungry, and
They're
driven.
okay too. That's all right. Actually, I just have one last one. Question we ask you every single year, which is any predictions for questions that will get asked tomorrow, or what would you like to ask Warren?
I'd like to, ask Warren, what does he think about this current environment in Washington and get his senses. Does he think now the stock declines that have occurred have been so dramatic over the year to date, even though I know we've started to have a comeback here recently, does he feel like this is a good time to buy? He's done that rarely over time, but we remember during 2008 and 2009 when he talked about he was buying stocks personally, and that was the bottom of the market in 08 and 09 during the financial crisis. So I'd really like to know whether he's going to start to be more bullish. We know he's been generating a lot of cash the last couple of years. We talked earlier about doing some of the selling. So that's the question. Is he getting more bullish? Is he going to be buying stocks in this environment? Is this an opportunity for all of us?
Warren will say, I thank everyone for being here. Thanks for the American system of capital allocation. And I don't think he's going to say much about the current administration and about those dynamics. I just echo again the fact that the capitalistic system of the rule of law, free market system, and meritocracy all work. Beyond that, I hope Warren continues to do what he always has done, and that is talk about things that are happening at insurance and happening at various parts of his business and not dealing with tariffs, taxes, and trade issues, but he will.
I think it's a great place to end it. Thank you, John. On behalf of everyone at Gabelli, thank you for joining us again. Thank you, too. And thank you all for joining us.
This podcast is an excerpt from Gabelli Fund's Gabelli Omaha Value Investor Conference. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of December 31st, 2024, affiliates of GAMCO Investors Incorporated beneficially own 30.63% of Atlanta Braves Series A, 6.07% of Series C, 11.67% of Paramount Class A and less than 1% of Class B, 5.2% of Madison Square Garden Sports, 5.17% of Sphere, 4.59% of Grupo Televisa, 1.87% of Iveco, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914, 921-5100 fax, 914-921-5118 info@gabelli.com.